On today's video, we're going to uncover everything to do with mortgages, from how do you qualify for a mortgage, what is a mortgage, and what do you need to know before taking a mortgage. Welcome to Business Talk with Elaine, where we cover everything about investments, financial literacy, and anything to do with money. A mortgage is a loan that is used to purchase property, which can either be a land, a house, or even a building. The duration of a mortgage can be of 10 to 30 years. What makes a mortgage different from other loans? First things first, we need to acknowledge that a mortgage is a secured loan. What do we mean by that? A secured loan means that the property is the collateral or the security in case you don't pay back your mortgage. What do you mean by secured loan? In case you fail to pay your mortgage or you fail to make the monthly payments as agreed upon by your lender, or the bank or the financial institution that lended you the mortgage is going to have to take back your property as collateral to pay back the loan. I hope you understand what a mortgage is, what makes a mortgage different from the other types of loan, and who give out loans, who give out mortgages. The people who give out mortgages are banks and financial institutions. Before covering anything to do with mortgages, we need to understand the terms that are used in a mortgage. These are very important because to understand what a mortgage really is, you need to understand these terms. We have the principal, we have interest, we have foreclosure, we have down payment, we have amortization, and we have equity. Let us begin with down payment, because that is what you begin with. A down payment is an amount you put down. The bank or the financial institution that is lending you can give you the mortgage. So basically, for a mortgage you have to pay a certain amount of money so that the bank can now come chip in to pay the balance. You have to understand that each financial lending institution has a certain percentage that requires you to pay as down payment. Some may prefer 10%, some may go for 20%, others may even go for 15%. It's according to the financial lending institution. The other thing we are going to cover is interest is the amount you pay monthly. Principal is also the amount you pay monthly. So interest and principal are paid monthly. Principal is the amount you pay monthly, but this one is the amount you pay with no interest. Now interest, since the bank gave you money, you have to pay it with some sort of additional value. So that is where the interest comes in. The principal is the money you're supposed to pay the bank with no interest in it. And now the interest is where the bank has you pay for the service it gave you. Now the other term we're going to talk about is amortization is the process where you pay back the principal and the interest. The next time we're going to talk about is foreclosure, is where in case you fail to pay back the loans in installments as agreed upon with your financial institution, they can take back the property. This taking back the property so that it can repay back the loan is called foreclosure. The other thing we're going to talk about is equity, is the property itself. This one is what you're paying the mortgage for. So equity is basically the asset you have. It is the property. That's it for covering the terms used in a mortgage. We've seen there's down payment, there's principal, there's interest, there's foreclosure, there's amortization. Those are the main important things you should know. And also the equity, which eventually turns out to be your property. The next thing we are going to cover is how do you take a mortgage? How do you know you qualify for a mortgage? The first thing you're supposed to do is identify the property. Identify what type of property you want. And now after identifying the property you want, you can now approach the bank so that you can get the mortgage. The bank has some qualifications it usually checks before it qualifies you for a mortgage, and this process is where we call underwriting. Where the bank checks whether you qualify for a mortgage is the process we call underwriting. This is actually a very important thing because it will determine whether you qualify for the loan or the bank will not give you the mortgage. So what the bank checks is your existing debts, your credit score, your stability of incomes, your pay slips, your income statements, and these things are the ones that determine whether the bank will give you the mortgage or not. In case your credit score is not good enough, you've not been repaying the previous loans well, they may not give you the mortgage. So after the bank sees you qualify for the mortgage, you have to pay a certain down payment. As I said before, the down payment can be of whichever percentage according to the lender. It may be 10%, 20%. So you have to pay the down payment first. And now the other process is where the bank funds the rest of the money that is remaining. And that is how you get your mortgage. The mortgage is basically where the bank is going to fund the rest of the money. You've paid the down payment, now the rest of the money you're not able to cover, the bank is going to pay. Now, since we are done with covering how do you qualify for a mortgage, we have to understand, why do people take mortgages? And the most important factor is that most of the people cannot generate all that income at once to buy a house. So they prefer to do it in installments, and a mortgage enables you to do that and own property eventually through these payments. So before you take a mortgage, there are some certain factors you should look at. What are some of the factors you're supposed to consider while taking the mortgage? Do you have stable income? Because for a mortgage you have to make monthly payments, and failure to do this, there's foreclosure, where I've told you the bank or the financial lending institution can take your property and use it to pay back the loan. The thing you're supposed to consider is, are there any hidden fees? The next thing you're supposed to consider is the location of the property and the condition of the property. That's it for Business Talk with Elaine. We'll catch up on the next video. In case you're into investments, saving, money talks, financial literacy, this is the channel for you, and consider subscribing. Till the next video, continue making wise financial decisions.